Assalamualaikum and hello everyone. Welcome to our presentation. Today we'll be presenting our topic, which is auditing non-current asset. My name is Nur Izzati Binti Mustafa. My matric number 06DAT24F1082, and together with my group member, we will explain the key aspect of audit non-current asset, including the nature of non-current asset, audit accession, accounting treatment, audit procedure, and the audit evidence required. So, let's begin with the nature of non-current asset. Non-current assets are long-term assets that a company uses in its business operation for more than 1 year. These assets are not bought for resale. Instead, they help the company generate income over a long period. Common examples include land, building, machinery, vehicle, and office equipment. Another important characteristic is that non-current assets are illiquid assets. This means they cannot be easily converted into cash within a short period compared to current assets such as cash or inventory. In terms of accounting standard, non-current assets are mainly governed by MFRS 116 or IAS 16, which covers property, plant and equipment, and IAS 36, which focuses on impairment of assets. Next, the core principle is that these assets are initially recognized at cost, or in some cases, at a revalued amount. After that, their carrying amount is reduced by accumulated depreciation and any impairment losses to reflect their current value in the financial statement. Understanding the nature of non-current asset is important because auditors need to ensure that these assets are properly recognized, accurately valued, and fairly presented in the financial statement. This is all for my part. Thank you for listening. I will now pass the presentation to the next presenter, who will explain the audit accession and accounting treatment for non-current assets.
Assalamualaikum and good morning everyone. My name is Nurlis Kaisara binti Zamri and my matrix number is 06DAT24F1077. Now, I will explain subtopic 4.2, which is audit accessions and accounting treatments for non-current assets. First, now, let's look at the audit accessions. Audit accessions are claims made by management regarding the financial statements, and auditors need to verify whether these claims are true. The first accession is existent. This means the auditor must ensure that the non-current assets such as buildings, machineries, and vehicles physically exist and are still being used by the company. Evidence can be obtained through physical inspections or asset verifications. The second accession's right and obligations. Here, the auditor checks whether the company legally owns the assets. This can be verified by reviewing supporting documents such as land titles, purchase agreements, or ownership certificates. The third accession is valuations and allocations. These ensure that the assets are recorded at correct value. The auditor review whether depreciation has been calculated correctly based on the asset's useful life and whether any impairment losses have been recognized when necessary. Next, let's move on to the accounting treatments under MFRS 116, Property, Plant and Equipment. According to MFRS 116, non-current assets are initially recognized at cost, which includes the purchase price and any cost directly attributable to bringing the asset into use. After initial recognitions, a company can choose either the cost model, where assets are carried at cost, less accumulated depreciations and impairment losses, or the revaluations model, where assets are carried at their revalued amount based on fair value. Finally, this asset must be depreciated systematically over their useful life, except for land, which is generally not depreciated because it has an unlimited useful life. That concludes my presentations. Thank you. And I will now pass the presentations to the next presenter.
Assalamualaikum and selamat sejahtera. My name is Nur Naziha binti Baginda Ali. Matrix number 06 DAT24F1096 from DAT5E. Now, I will explain the accounting system and control activities related to non-current assets. First, let's look at the accounting system. The company uses a fixed asset register to record and monitor all non-current assets. This register contains important information such as the asset cost, acquisition date, depreciation, and carrying amount. By keeping these records up to date, the company can monitor its asset accurately and prepare reliable financial statements. The accounting system also supports the planning and approval of capital expenditure or CapEx before new assets are purchased. Next, I will explain the control activities. Firstly, management approval is required for all CapEx purchases. This ensures that only necessary and authorized assets are acquired. Secondly, each asset is given an asset tag and is physically verified on a regular basis. This helps confirm that the assets actually exist and are being used properly. Thirdly, the fixed asset register is updated whenever there is an acquisition or disposal of an asset. This ensures that the asset records remain complete and accurate. In addition, the company performs reconciliation between the fixed asset register and the general ledger. This helps identify and correct any differences or recording errors. And finally, the company applies segregation of duties, where different employees are responsible for approving, recording, and monitoring assets. This reduces the risk of errors and fraud while improving accountability. In conclusion, an effective accounting system together with strong control activities helps protect non-current assets, ensures accurate financial reporting, and strengthen the company's internal control system. That's all from me. I will hand this presentation to the next presenter. Thank you.
Hi guys, my name is Amira and now I will explain about audit procedure. So first is the existence of test of control. First is we can verify that all of the assets are properly authorized by the management. It is because we want to ensure that the genuine asset purchases are recorded. Next is check that the fixed asset register is updated properly after asset acquisition and disposal. It is because we want to keep that the asset records are accurate and complete with all of the information. Last is to ensure that periodic physical verification of the asset is performed and discrepancy are investigated. It is because we want to confirm that the asset actually exists and we can detect the missing asset. Next is the ownership of test of control. So first is we want to verify that the title, deeds, and other ownership documents are securely maintained. It is because we want to prove that the company legally owns the assets. Second is we want to ensure only authorized personnel can approve fixed asset acquisition. It is because we want to prevent unauthorized asset in the company. Next is we review control to ensure ownership documents are properly recorded, filled and safeguarded. It is because we want to ensure the ownership documents are available and protected. So that's all from me. Bye.
Hi, I'm Naminalina Betiza Gilfrey, number matric 0682 for F1090. Now, I will explain the substantive procedure for auditing non-current asset. The first procedure is to physically inspect a sample of asset listed in the fixed asset register. The auditor compares the physical asset with the FAR records. The audit evidence obtained is the physical asset and the FAR, which is support the existing assertion by confirming that the asset actually exists. The second procedure is to inspect title deed or registration certificate. This legal document provide evidence that the company owns the asset and support the right and obligation assertion. The final procedure is to recalculate depreciation expenses. The auditor review the depreciation schedule to ensure that depreciation is calculated correctly. This provides evidence for the valuation and allocation assertion by confirming that the assets are recorded at the correct value. In conclusion, this substantive procedure provides sufficient and appropriate audit evidence to support the audit assertion and ensure that non-current assets are fairly presented in the financial statement. That's all from us. Thank you very much.